Good afternoon, everybody. My name is David Eckhart. I'm Senior Vice President here at Florida Credit Union. We're very excited that you're here listening to our webinar today. I'm here with Ken Toops and Mark Paladino, our partners from CUSO CFS. And today's educational webinar will be Saving for Retirement, IRA Needs to Know. Without further ado, I'm going to turn it over to Ken Toops.
Hey, thanks so much, David. Yeah, my name is Ken Toops, and I've been a financial advisor here at the Florida Credit Union for going on over 10 years now. I help our members out in the Alachua County area, Columbia County area, and the Bradford County area. And I'm joined here today with my partner, Mark Paladino, and I will let him introduce himself.
Hi, I'm Mark Paladino. I've been a financial advisor for over 25 years, and in that time, I've helped thousands of members plan, build, and pass on their wealth. I help members in Marion and Volusia counties and the rest of Southern Florida. And now I'll turn it back over to Ken.
All right, thanks, Mark. So I think we're going to go over some pretty good information here today. We're going to be talking about IRAs and some of the differences and the need to knows. Now, you might want to take a minute to go ahead and grab a pencil and paper. If you want to jot down any questions, there will be time to answer questions after this presentation. If you look over on the right-hand side, you should see a questions tab. So if you click that, you should be able to type your question in. With no further ado, let's go ahead and get started. So here's our agenda for today. We're definitely going to be talking about why it's so important to save for your retirement. We're also going to be talking about some how-tos. So we're going to talk about the differences between some traditional and Roth IRAs. We're going to talk about rollovers. Many of you might have a previous retirement plan from a previous employer, and you're not sure what to do with it. We're also going to talk about required minimum distributions from a retirement account. We'll talk about ways to get guaranteed income that lasts your lifetime. And lastly, we're going to talk about beneficiaries and the differences between primary and contingent beneficiaries. So first, let's talk about why it's so important to save for retirement. And I'm going to read you a stat here. So pensions are becoming less and less common, and according to the Secure Retirement Institute, 31% of baby boomers, 21% of Gen X, and only 14% of millennials are going to have access to a pension. So Social Security income accounts for only about 41% of a retiree's income. So relying on your personal savings is more important than ever. So I'm also going to talk with you about how saving early and often can really make a difference. And we're going to see that on this next slide here. So if we're looking at this slide, this is going to really demonstrate the time value of money and how your account can grow with compounding interest, and especially if it's tax deferred or even tax free. So in this slide, we're looking at a hypothetical example of an individual who decides to contribute $7,000 a year. So over the 20 years from age 50 to age 70, so over that 20-year period, they've contributed $140,000 to the plan. Now, assuming a 6% return on an annual basis, that $140,000 would have grown to $257,499 over that 20-year time period. Next, I want to talk about the two different types of individual retirement accounts. So I get this question all the time, what IRA is right for me? Should I go a traditional or should I go with a Roth? And they both have their advantages. So one of the big differences between a traditional and a Roth is going to be what kind of money you're using to fund it. So with a traditional IRA, we're going to be funding that traditional IRA with pre-tax money. So in other words, let's say that an individual makes $50,000 a year, and let's say that he contributes $5,000 to a traditional IRA. Well, because it's pre-tax money, now you're going to be paying taxes on your ordinary income as if you've made $45,000 as opposed to that $50,000. So you'd be saving your taxes in the year you contribute. Now, contributions are generally going to be tax deductible, but not always, and we'll talk about that in just a few slides. Now, with a Roth IRA, you're funding a Roth with after-tax money. So in that same example, an individual who makes $50,000 and decides to use $5,000 to fund a Roth IRA, well, they still pay taxes on their ordinary income as if they've made $50,000. Now, when you make a distribution from a Roth IRA, typically it's going to be tax-free. So let's go more into traditional IRAs and how they work. So with a traditional IRA, to be able to make a contribution, you have to have earned income. Now, earned income is going to be defined with wages, if you're on salary, if you have a job where you make commissions or tips, those are going to be sources of earned income. Now, what they don't count as earned income is going to be, say, like retirement income. So if you're currently collecting annuity or Social Security income or pension income, that would not be classified as earned income. Now, if you want to make a contribution to a traditional IRA, you can make a contribution of up to $6,000, assuming you've earned at least what you contribute. And if you're over the age of 50, you can actually do an additional $1,000, making it a grand total of $7,000 you can contribute on a yearly basis. Now, you can contribute at any age to a traditional IRA, and that's a fairly new change to the IRA rules. Now, they're deductible up to a certain adjusted gross income, and we'll talk more about what adjusted gross income means in just a few slides. Now, non-deductible contributions are allowed, and the example I would use there is, let's say that if Jeff Bezos, the richest man in the world, decided he wanted to make an IRA contribution, well, he could do so. But because he makes more than the adjusted gross income that they would allow for a deductible contribution, his contribution would be non-deductible. But there's going to be some benefits to that, and there's going to be a loophole that we're going to talk about in just a few slides as well. So with a traditional IRA, all of those investments can grow tax deferred. Now, Mark and I can definitely help you guys, determine, the right type of investments inside of your IRA account. Now, if you have a traditional IRA, you will be required to start making required minimum distributions beginning at the age of 72. Now, age 72 is a recent change as well, and some of you out there might already be taking required minimum distributions when you turn to age 70 and a half. Next, I want to talk about withdrawing from a traditional IRA before retirement age, which is 59 and a half. So the IRS does grant certain exceptions to withdrawing early out of a traditional IRA. Now, the most common are going to be if an IRA holder passes away, if the IRA holder becomes disabled, they can use up to a certain amount for a first-time home purchase, and they can also use some for qualified higher educational expenses. Now, some less common but also exceptions are going to be if you have unreimbursed medical expenses that exceed 7.5% of your adjusted gross income, if you're making health insurance premiums when unemployed. You can also set up what's called a 72T, which allows you to take periodic distributions from your retirement plan before the age of 59 and a half. And you can also, which is a new rule, up to $5,000 for birth or adoption expenses. Pretty much any distribution out of a traditional IRA under the age of 59 and a half, if it doesn't meet one of these exceptions, you'll be hit with a 10% IRS penalty. Now let's talk about withdrawing from an IRA after the age of 59 and a half. So any withdrawal from an IRA, a traditional IRA, will be taxed as ordinary income. Now, what that means is, if you have an IRA account and we had to take a distribution of $10,000 out, and let's say that you have earned income of $50,000, well, now your ordinary income is going to be as if you made $60,000. Now I want to talk about Roth IRAs. So Roth IRAs work very similar, but also there's some very important differences between the Roth and the traditional IRA. So one of the similarities are going to be you have to still have earned income to be able to make a contribution to a Roth IRA. Now it still has the same $6,000 a year contribution limits with an additional $1,000 catch up if you're age 50 or over. With a Roth, you can contribute at any age. Now they do have adjusted gross income limits on contributions. There is a little bit of a loophole around this, and we'll get to that in just a few slides. Now, Roth contributions, remember, are going to be funded with after-tax money. So investments inside of a Roth IRA are going to grow tax-free. When you take a distribution from a Roth, as long as those requirements are met, they will also be tax-free. Now, one of the big differences between a traditional and a Roth IRA is a Roth IRA is not going to require you to take those minimum distributions on a yearly basis at age 72. So withdrawing from a Roth IRA, it's going to be tax-free as long as we meet these rules. So the amount that you contribute to a Roth IRA, if you were to withdraw that, is always going to be tax-free because you've already paid taxes on those contributions. Now, if you conversions are tax-free as long as the Roth IRA has been open for more than 5 years or you're age 59 and a half or older. We're going to talk more about those conversions on the next slide. Now, earnings are going to be tax-free as long as the Roth IRA has been open for more than 5 years and you're age 59 and a half or older. So as long as we meet all of those rules, we should not be paying taxes on any distribution from a Roth account. Let's talk about converting. So you can actually convert a traditional IRA to a Roth at any time. Now there's no adjusted gross income limitations on doing this conversion. And what adjusted gross income is going to be your gross income minus any adjustments or deductions to that income for tax purposes. So if you convert from a traditional IRA over to a Roth IRA, it's going to be taxable income in the year that you make that conversion. Any non-deductible traditional IRA contributions will convert over tax-free, and this will be the backdoor loophole that we'll talk about on that next slide. So a 401k can also be converted directly over to a Roth, but again, that will be taxable income in the year it's converted. Not always the best idea to do a full conversion from a Roth to a traditional because it can incur some pretty significant tax consequences. So I would definitely recommend that you talk with your tax advisor before deciding if you want to make this conversion. Well, now I want to talk about that loophole that I've mentioned in a few slides. So we mentioned how if your adjusted gross income is too high, you can't make a Roth contribution. But if you remember on one of the first slides, we also mentioned that if anybody at any age with any income can contribute to a traditional IRA, just if you make too much, you might not get the tax benefit. So what the backdoor Roth IRA conversion allows you to do is allows you to make a contribution to a traditional IRA, and you can immediately convert that to a Roth IRA. So let's go over an example of how that would work. So let's say we have a client, they're 45 years old and they're single. They earn too much money to be able to contribute to a Roth IRA. So they contribute to their 401k and they don't have a traditional IRA. Well, they do a $6,000 non-deductible traditional IRA contribution, and then they could immediately take that $6,000 non-deductible traditional IRA contribution and convert that over to a Roth IRA. So that's a way to kind of backdoor into a Roth if your adjusted gross income is too high. Now, I get a lot of questions with clients about rollovers. And there's definitely benefits and there's, some disadvantages to making these rollovers. So I want to go over some benefits first. So one of the big benefits to taking your 401k, or if you have a 403b, or just about any type of employee-sponsored retirement plan, is you're going to have very limited selection options inside of those plans. Typically, you're only going to be able to invest in mutual funds. And while I think mutual funds can be a great investment, there's a lot of other investments that you just don't have access to inside of a 401k. So if you decided to roll over your 401k or retirement plan to an IRA, well, now you're going to have thousands of different options. And those, it sounds like a lot, but it's definitely something Mark and I would be able to help you out with, determine what type of investments, would be a suitable investment for you. Now, another benefit of a rollover is you can choose some of these different investments will come with guaranteed income, such as annuities. Another great benefit of a rollover is if you take a distribution out of a 401k or a 403b, well, they typically do a mandatory 20% withholding for tax purposes. And sometimes that's enough, sometimes that's too much, but you don't really get a say so. And if you wanted to have less than that withheld, with an IRA account, you would be able to have that. So if you didn't want to have any taxes withheld, you don't have to. Now just know it's taxable income. But if you wanted to, say, withhold 10% or 12%, well, an IRA would allow you to do that. Well, we talked about some benefits, and I definitely want to make sure that we're fair and talk about some potential disadvantages of a 401k rollover. So if we look at the disadvantages, if you leave your job in or after the year that you turn age 55, most 401k plans will allow you to tap into that 401k while avoiding that 10% early withdrawal penalty. Now, IRAs will not allow you to do this. Now, another disadvantage potentially is if an employee is less than a 5% owner of a business and they continue working past the RMD age of age 72, that employee can actually defer their RMDs until they separate from service. When can you do a rollover? The rollovers can typically be done if you are no longer making contributions to that 401k and you no longer work for that company. So if you switch jobs, if you retire, if you get fired, that's typically going to be when you can do a rollover from a 401k over to an IRA account. Now, it's few and far between, but some plans will allow you to do rollovers prior to separating from service. Next, I want to talk about required minimum distributions and what we can do with those required minimum distributions. So we list 4 options. First option, we can delay taking an RMD out. Second option is we can gift that RMD. We can convert that RMD. And if we want to, we can turn that RMD into guaranteed income. And we're going to talk about delaying first. So if we chose the first option to delay taking a required minimum distribution, you would have to open what's called a qualified longevity annuity contract. Now, what this will allow you to do is you can actually delay taking required minimum distributions on up to $135,000 in an IRA account until you turn age 85. Now, a drawback to doing this is potentially that 135,000 may be a small part of your IRA balance. Another drawback is going to be you lose some growth potential because it's going to be invested in a fixed account. Now, if we don't want to delay it, another option is going to be we can gift our required minimum distribution. So if you chose the gifting option, we make a qualified charitable distribution, and you have to be age 70 and a half to have this as an option. So if we choose to, we can actually do up to a $100,000 gift directly to a charity. Now, the amount that goes over to that charity is not taxable income to you. It will also satisfy your required minimum distribution for the year. So it's always an option. If you don't want to take the money out and pay taxes on it, you can always gift that over to a charity of your choice. The next option is going to be we can convert. Now, there's no RMDs, remember, for a Roth IRA account. So if we had a traditional IRA account or a retirement account that's all pre-tax money, if we chose to, we can always do a conversion into a Roth IRA account, and that will get rid of your required minimum distributions going forward. But you have to remember, if you make this decision, that full amount that you convert is going to be taxable in the year that you make that conversion. So please talk with your tax advisor just to make sure that that's going to be something that benefits you. Now, the fourth option is you can turn this into a guaranteed income stream. So if we chose to do this and purchase an annuity, well, an annuity is going to give you a lifetime income stream that you cannot outlive. Now, most annuities out there are going to have a certain amount that they pay you out, but if your retirement account, the required distribution gets higher, a lot of these contracts are RMD friendly, and will then give you the extra amount as your required minimum distribution. So we spoke a little bit about annuities in this slide, and I kind of want to talk on the next slide about understanding annuities just a little bit better. So there's three main types of annuities. There's a variable annuity, there's a fixed annuity, and there's an indexed annuity. Not all of these annuities are going to be right for everybody, but some of these annuities could be a very good part of your investment portfolio. Again, this is something Mark and I will be able to help you out with. So one of the good things about annuities, depending on the type that we choose, is it can give you growth potential. So earnings are going to be based on the performance of an investment inside of that annuity. Now, another benefit is going to be tax deferral. Now, if we're talking about funding an annuity inside of our IRA account, well, we already have the tax deferral benefit. But let's say that you have a large sum of money outside in, say, like a checking or savings account. Well, if we then invest it into an annuity, that annuity will be tax deferred. So that could be a big benefit for you, especially if you have non-retirement funds. Now, one of the big features of an annuity, and especially like a variable annuity or a single premium immediate annuity, is going to be it's going to guarantee lifetime income. So one of the retirees' biggest fears is running out of money in retirement. What an income annuity will do is help ease that peace of mind, knowing that you're going to have a monthly check coming in no matter how long you live, and even if you were to run that account down to zero. Now, one of the things that annuity does lastly is you can have an annuity set up to leave a legacy to loved ones. So there's certain annuities out there that are great for their death benefits. And again, this is something that Mark and I would be very happy to talk with you about if you have some questions on annuities. So I mentioned that one of the big concerns in retirement, obviously, is going to be running out of money. That's why guaranteed income is so important. And there's really only three sources of guaranteed income that I know about. That's going to be your Social Security income, if you're lucky enough to have a pension with income, and if you have an annuity. Those are going to be your three sources of guaranteed income. Now, this might help you. Say you were making a certain amount when you were working, and maybe Social Security is not covering it quite enough. We might have a gap in income, so you can always use an annuity to help supplement and fill that gap for your day-to-day living expenses. Now I want to talk about naming beneficiaries on your financial accounts. Now, if you have not done this lately, please, please, please make sure you do this yesterday. It's so important to make sure that your beneficiaries are listed how you want them listed in the event something happened to you and you were to pass away. So in an IRA account, why it's so important to list a beneficiary is that money is going to avoid probate. Those funds will get directly passed to your beneficiaries. Now you can change or update your beneficiaries at any time. And you might especially want to update those beneficiaries if you go through a major life change, such as if you recently got married, maybe you recently got unmarried, or had a birth of a child or grandchild, or if one of your beneficiaries that you had listed has passed away. There's two types of beneficiaries, and I want to make sure that we understand the two different types. So we have primary beneficiaries, and we also have contingent beneficiaries. Now, a primary beneficiary is going to be who your assets get passed to if you were to pass away. Now, there can be as many primary beneficiaries as you'd like listed, as long as it adds up to 100%. Now, with a contingent beneficiary, that's going to be the beneficiary who gets the assets passed to them if all of the primary beneficiaries are deceased. So an example would be, let's say that a husband was with his wife and they were driving in a car. And let's say they had each other listed as their spouse listed as primary beneficiary. And let's say they had their kids listed as contingent beneficiaries. Let's say an accident happened and both spouses passed away in that accident. Well, then the assets get passed to the contingent beneficiary. So that's the difference between primary and contingent beneficiaries. Now, what do you do if you inherit money from an IRA account? You have a few different options, and you have a few more options if you're a spouse. So if you're a spouse can usually continue the IRA account. They'll usually roll those funds over into an inherited IRA, or I believe they can even enroll those into their own IRA account. Now, they would also have the option to take a lump sum distribution from that IRA account, or they can do what's called an out in 10 years, which is they would have to take that value out over a 10-year period. And by doing it that way, you could potentially reduce the taxes that you owe. Now, if you're a non-spouse, you don't have the spousal continuation benefit. So you're going to be able to either take a lump sum or you can stretch it out in 10 years. And I want to talk about some examples on taking it out in 10 years. So first, we're going to go over if we decide to take it as a lump sum and why sometimes that might not make the most sense. Well, in this example, our beneficiary Jane is age 55 and she earns $250,000 and just inherited a $100,000 traditional IRA. Well, that $100,000 might put her in a tax bracket that she's not comfortable with or thinks she's going to be paying too much. So what Jane could then do is choose an out in 10. So the same example, Jane inherits a $100,000 traditional IRA. She would then be able to take that $100,000 out over a 10-year period, which could reduce the taxes owed on this inheritance. So let's look in the first year, she decides to take $25,000 out. Next 2 years go by, she didn't need to take anything. And then let's say maybe she needed a new roof. So she takes an additional $30,000 out in 2023. Next year, she takes $15,000 out. And she's got $30,000 left to take out over the next, 6 years. So the next 5 years go by, she decides not to take that out, but she knows on that 10th year, she's going to have to take the remainder out. So she pulls then the remaining $30,000 out. So that's the out in 10. Now with IRAs, Let's talk about contributions. So 2021 contributions can be made all the way up until April 18th of 2022. Now I know the slide says April 15th, and that's usually in typical years, but this year it's actually going to be up till April 18th. Now to make a 2022 contribution, that can be made anytime all the way up until April 15th of 2023. So you still have time to make a contribution back to 2022. Now for required minimum distributions, if you're already age 72, your first required minimum distribution is going to be due by April 1st of the year following the year that you turn 72. Now, every year after that, you need to take your required minimum distribution out by the last day of the year. So you need to take it out by December 31st. Now, a required minimum distribution amount is always going to be determined based on the account value on the last day of that calendar year. So let's go over what we covered today. So we talked about the importance of retirement savings. We went over some rules for IRAs with Roths and traditionals. We went over advantages and potential disadvantages of rolling over a 401k or a 403b or another employee-sponsored retirement plan. R&D strategies, what to do with those required minimum distributions. We talked about those 4 options. How to make an IRA work for you in retirement. And then we also talked about leaving those assets to beneficiaries. So now I would love to answer any questions that you have. And if you joined us late, there should be a tab over towards the right-hand side that you should be able to type in any questions, and I'll take a look at some of those now. All right, so one of the first questions we have is there any cost to meet with me or Mark? And that's a great question, and absolutely not. There's no cost or fees, there's no obligation. Mark and I are here to help the members here at the credit union. So if you'd like to, I'm going to put the slide up next that has our contact information. Please feel free to either shoot us an email or give us a call. We'll be happy to answer any questions that you might have that maybe we didn't discuss today on today's webinar. All right, let's see if there's any other questions. Is there still time to make a contribution for 2021? And yeah, we just spoke about that. So we have up until April 18th to make a contribution for 2021. And for right now, that's all the questions I see. So if there's no other ones, I want to thank you so much for your time. I want to thank you for joining us. And please, oops, hold on 1 second. I'll put the contact information up. All right. So here's our contact information. If you want to jot our emails down, or if you want to give us a call, we have our extensions up there. Again, I handle the Alachua County area, the Columbia County area, and the Bradford County area, and all surrounding areas. Mark's going to be handling the Marion County and the Volusia County areas. So we are more than happy to help you out with anything that we can do to help you out, any of your investment needs, or just if you have any questions. But I do want to thank you so much for your time today, and I hope you got some useful information out of it. Thank you so much.